Hi, this is Brandon Bischoff with Canterbury Investment Management, bringing you this week's Canterbury Market Update for the week of November the 25th, 2019. So starting with the market state, we are still in market state 1. As a reminder, market state 1 is one of the 5 bullish market states. So for market state 1, the long-term indicators are positive, volatility is low and decreasing, and short-term indicators are positive as well. Going back to kind of our market state environments to give you a brief reminder of those. Like I said, the first 5 are bullish. That means they have, low and decreasing volatility, and risk is, it's low risk, it's an efficient kind of market. We then have transitional markets where either risk is increasing, kind of going from a bull to a bear, and volatility is increasing, or maybe it's coming from a bear to a bull where you have declining volatility, but it's still high nonetheless. And then you have bear markets, which are high risk, there's inefficiencies, volatility is high, and your risk is really unlimited. So Canterbury Volatility Index currently measures CDI 53, so volatility kind of continues to be low, stable, and continues decreasing, dating back to early October when volatility was a little bit higher. We've mentioned in the last couple updates that the 10-day volatility, or a short-term volatility index, is at an extreme low. It's actually at a rating of CDI 24. So our Canterbury Portfolio Analytics group, we did a study where we took the market since 1950, or the S&P 500 since 1950, and we wanted to find out how many periods this occurred where volatility has entered that extreme low territory, gotten all the way down below 25 before coming out of that extreme low territory. And there's really 74 different instances of this occurring. And of those 74 instances, we've mentioned that declining volatility is like this squeezing down of a spring, and you might see a market outlier or a market pop following a period of extreme low volatility. Well, 47 out of those 74 periods ended on a day of plus or minus 1%. So you did see a volatility pop, and 33 of those were down, while the other 14 were up more than 1%. Additionally, if we measure the 3 months after this volatility spike occurs, so what kind of happens? Does the market go back to being bullish? Does it go to transitional? Does it go to something different? We noticed that 31 of those periods out of the 74 experienced at least a 5% drawdown over those next 3 months, whereas only 9 of them actually went beyond 10%, and only 4 experienced what's beyond a normal market correction of 12%. And so what this kind of tells us is even if volatility does spike, there's still a process to go from a bull to a bear. It's not going to happen overnight. We're not going to see volatility spike and the market turn instantly bearish. It'll require a process to get there. So it also seems like a while ago that we last saw an outlier day beyond, plus or minus 1.5%. And this is because, we're in a bull market environment, and markets, they're really not random. So during bull markets, you're less likely to see those wide fluctuations, right? Whereas in a transitional or a bear market, that's when we start to see those outlier days come in clumps. And we can if we look at a chart of 2006 to 2009, we'll notice that in 2006 and the early part of 2007, when you're in a bull market, the daily fluctuations generally stay within a third standard deviation, or really generally within a second standard deviation, which 95% of all trading days should stay within minus 2% to plus 2%. This is what happens in that bull market. But then as the market begins to turn transitional and then later bearish, you see a lot more outlier days. You see days pushing, plus or minus 3% the transitional markets. And then as we hit that bear market, that's where you're getting days that can range anywhere from down 9% to up 10%. So there's a lot of variation, a lot of high volatility in bear markets. And so if we just look at the last 3 months where we've experienced both a bull market and some transitional markets, we'll notice that during those bull market days, the volatility is much less, the daily fluctuations are much tighter, whereas in those transitional markets, you see a lot more days beyond 1.5%. So moving on to the Canterbury Portfolio Thermostat, looking at our efficiency score, Portfolio Thermostat is efficient for the current market environment. I know we mentioned volatility on the short term is getting squeezed down like a spring, and you might see a volatility outlier or market spike. If that does happen, the Portfolio Thermostat does have a benefit of diversification of 49%. So that should stabilize out the portfolio if you do see a volatility spike. But we're nonetheless positioned for the bull market environment at this moment. So bottom line, the market, is bullish. It has low and decreasing volatility. Short-term volatility is getting squeezed down, But the point we want to make here is, if we do see a volatility outlier, markets don't go from one extreme to the other. We won't go from a low volatility bull to a high volatility bear overnight. There is a process required. And like we've mentioned many times before, the Canterbury Portfolio Thermostat is designed to navigate ever-changing market environments. So while it may be positioned for a bull market today, if the characteristics of the market change, we will adapt with that. Anyways, that brings us to the end of this weekly update, and I hope you have a great week.